Thank you, Nick. There's three aspects to what I'll talk about today. We'll touch upon the macroeconomy and the key drivers of the economy that influence commercial markets. I want to spend a bit of time talking about yields and growth expectations. That's very topical at the moment, particularly in the context of where Australian yields are sitting relative to global yields. And finally, we'll drill into the sectors and the current fundamentals that are driving the Melbourne market versus the rest of the country. If we look at the key themes from an economic perspective, I think from what Nick's just told us, really you can distill it down to the world is no worse than 12 months ago. So there's still some uncertainties. There have been last year as well. But really, if you look at the growth expectations, modest improvement this year, 2014 is looking better. There's no change to the actual influence that's having on our local markets. Similarly for the Australian economy, I describe the Australian economy as moving sideways unspectacularly. Really the market, the component of the market that influences commercial property is what's happening outside of mining. And that's been exhibiting fairly stable growth in the 1.5% to 2% range for the last 2 years. That hasn't changed. There are some signs that some of the indicators in the non-mining components of the economy are turning, such as dwelling approvals, consumer sentiment, and we've also seen that retail turnover seems to be bottoming. So there's some more positive signals coming through. Not electric, unspectacular, but it's moving in the right direction. I guess Victoria's in a slightly different cycle. Been very strong since the GFC in terms of employment growth, in terms of retail activity, driven a lot by a strong housing sector. A slightly different cycle there. I see Victoria actually normalising back towards the national averages over the next year. So it's a cyclical issue really for the Victorian economy rather than a long-term strategic one. And I think feeding off that issue of what's cyclical and what's long-term, the fact that yields in most of the core prime markets across each sector, industrial, retail and office, have remained relatively stable. In fact, if you look at the premium end of the market, they've strengthened. The market as a whole is quite comfortable with medium to long-term growth expectations. If they weren't, they'd be requiring a high yield to actually invest. Further on that theme, we have seen areas of risk pricing improve, and that's pretty critical to the medium-term outlook for yield. So if you look at corporate credit spreads to government bonds, they've moved lower in the last 9 months. That's a positive factor. The share market's rallied 10% this year. That's also a supportive factor for all asset classes. And the final point is that there is a significant capacity to reinvest. So we do still have large cash allocations amongst super funds relative to historical norms. We have low levels of leverage. So as confidence improves, there is capacity for those things to drive significant investment back into the sector and all risk asset classes. It's an interesting mix though, if you read what's on that page. There's really a blend of subdued occupier markets, but rising investor appetite. And you're seeing that from global funds coming to Australia, and you're starting to see that re-emerge here with capacity for further. If we just look at the economy, the key thing for property markets is the light green line there. That's really if you strip out the effect of engineering investment on GDP, that component of the economy is what's driving a lot of the activity in the southeast. It's been growing at about 1.5% to 2% for almost 2 years. The expectation for growth next year, which sees the Australian GDP number fall back towards 2%, is really just reflecting that dark green line, which includes the mining component moving back towards the average. So I don't expect that by itself is going to have a massive impact. While the headline numbers will slow, it's not going to have a massive impact on what the underlying drivers are for commercial markets next year. Pretty critical though to the longer term outlook is what's happening to non-mining investment. We saw from the CapEx survey two weeks ago from the ABS that expectations for capital spend in 2014 still look quite subdued outside of the mining sector. And in fact there you can see the first fall in the mining sector expectations for 3 years. So mining is going to contribute less to growth going forward. Are we seeing a recovery in capital expenditure plans for the non-mining sector? We aren't quite there yet, I would say. There's still excess capacity in the non-mining sector because growth has been subdued. So we don't expect an investment or supply boom across that component of the economy anytime soon. I guess there's a mix of factors though. Manufacturing is obviously still very weak. That's pulling down expectations, whereas we did see a positive number, a 5% increase in expectations amongst all other industries. So that was an encouraging initial sign again, one of those signs of tepid recovery that I spoke about. And profitability really drives that and really drives what we see in occupier markets. And again, it's a bit of a mixed bag. You can see manufacturing's been under pressure. Profitability is still declining. The strong Aussie dollar is hurting that. We're still seeing examples of materials companies, CSR just this week, Boral previously, closing down plant, reducing numbers. So we're not out of the woods in terms of occupier market influences in some sectors. But you can see there in areas such as banking, profit levels have been restored to pre-GFC levels. Retail's moved above pre-GFC levels, and transport and storage is interesting. That's actually on quite a strong growth trajectory now. So there seem to be some quite strong fundamentals underpinning that sector currently, which we'll get into a bit later. If you look at Victoria in context for this, you'll see that Victoria's had a good run since the GFC. Some of the recent indicators there, you see retail turnover there slowing significantly in the last 12 months, and employment moving from a position of above national averages to below. So that's actually what I was referring to earlier around a cyclical slowing in Victoria. It seems to be a bit out of sync with the rest of the country at the moment. Housing activity is still pretty strong. A lot of that, as a proportion of the total of activity in Australia, is well above average, but that's because a lot of Australia has been very weak and we're starting to see those improve. So that'll normalise, not so much because Victoria slows sharply, but because the rest of the country starts to improve. And population growth there, you can see, is quite strong. So how do commercial property market investors actually distill this information, and how does that influence what we're seeing in terms of rental outcomes? We can see quite a diverse range of outcomes here. The retail sector growth rates have fallen significantly relative to their historical averages, so less than half the historical averages. And as we said before, we expect the retail's probably bottomed nationally. So we see that improving, but it's a different level of return that we'll get from that sector going forward. Office markets are slowing nationally, yet yields have remained quite firm. Industrial is really the momentum story at the moment. Industrial rental growth is over double the pace it has been on a long-term average, and that's actually seen yields decline in that sector relative to historical averages. So quite strong fundamentals for the industrial sector. Overall, transaction activity has been quite subdued in the office sector. These are the national numbers. If we looked at the Melbourne version of this, we'd actually see turnover for office a lot lower last year than that 5% nationally. But when markets don't transact a lot, it means there's not a lot of disagreement. So we've been talking about a fairly steady, stable outlook. It's not surprising then that markets would be in more agreement with that outlook, and that you wouldn't see a lot of turnover. So lower transaction activity is consistent with a fairly steady and predictable environment. If we can spend a bit of time talking about yields, there's a lot of focus on the spread between yields and bond rates. I mean, I think if you look at that historically, there's only really 3 periods where yields at a national level for office have moved significantly away from a long-term average. That was the recession in the early 90s, where yields moved up when rents collapsed. Pre-GFC, where yields fell by about 2 percentage points, and then post-GFC, where they reversed that change. If you take those events out, yields are generally fairly stable. The market's long-term growth expectation doesn't change that much. And I think we're pretty close to that sort of expectation currently. Now, this is looking at an average. Around that average, premium yields have fallen in office markets, and secondary yields have risen generally across most markets. So what may change the picture for yields? There are a range of factors and influences that I think will become more supportive, though, of that gradual drift lower in yields over the next 1 to 2 years. The first one is, I mentioned earlier, corporate credit spreads have contracted quite sharply. We still do have quite a wide premium, though, between AA rated debt and BBB. So the corollary for property markets is prime to secondary asset yields will remain wide while that sort of spread and that sort of risk pricing is required by markets. However, the overall position has improved